Hi, this is Brent with Trade Therapy, and welcome to the Trading Couch. We are talking about Robinhood markets. Hood was our clarity spotlight last week. And if you look at this clean weekly all-time chart with Hood, it's just a case study of how institutions plan their business model, how they execute on that plan, all the way back to initially coming out of IPO. Hood was a perfect example of engineered exit liquidity. The initial hype and vertical rally gave early investors and insiders the perfect opportunity to sell into all-time high demand at all-time high peak valuations. But what followed wasn't just a collapse. This was an engineered takedown into this long 2-year flat, very low volatility trading period. This is the telltale signs of the institutional buying range right here, all done on very low volume, a flat volume over a long period of time. That's not random. That's not retail holding price at this level. That's classic institutional buying behavior. During this period, they keep volume very low to quietly absorb supply. The last little bit of anyone that was left holding, trying to make it through, they want to absorb all of that supply at these levels, and they want to do it on very low volume so they don't attract any attention. They don't want competition for that supply. When price finally did break out last year, it broke above the ceiling right here. You see that level acting as resistance until it breaks out and then comes back and tests it. That is the definition of a pivot, changing from resistance into support. At that point is when Hood transitioned out of this institutional buying range and into a new uptrend or markup period. As swing traders, what we're looking for confirmation is we're looking for all of the weekly average to line up sequentially and sloping up, which we see a very healthy looking uptrend, very healthy looking chart. We can see that pivot, that transitional point as it breaks out of there into this uptrend. We do see last week poking up into new all-time highs on very high volume again, second highest weekly volume that Hood has ever seen here. What triggered that? Hype again. The inclusion into the S&P 500 during this latest rebalance was used to drive up expectations. It fueled retail buying at high options volumes, analyst upgrades. But the rebalancing ultimately went against Hood. They were snubbed. But that surprise didn't stop Hood from hitting all-time highs. What it did do, though, is it provided a perfect liquidity event for institutions to once again take advantage of, where they're selling into all-time high levels of demand at all-time high peak valuations, a behavior that Hood has demonstrated previously. So if we look at that volume spike right here, that's not random. It's a classic moment of institutions using headline-driven demand to test liquidity, to trim their positions while keeping control of the trend. This doesn't mean the trend is changing. It just means that they're controlling it. They're taking profit. You can see that it now is very extended away from this brand new 200 weekly exponential moving average that is automatically sloping up as soon as it hits the chart. Very bullish, very healthy, but it's that extension that triggers us to look into a little more detail to see if there's any levels that we need to be looking out for. If we add Fibonacci into just this local pullback here, we see the extension is getting up into that 14141618 pocket right there. That is a classic area where institutions or professional money will take profits. So we need to keep an eye on this 94 to 110 range. Institutions know they can't keep price running vertically forever. They also know they can't sit on all of these unrecognized gains forever. They do need to take profit. That is very healthy. That's what keeps the uptrend going, is allowing professional money to take profit and then reload at lower prices to then begin marking up and pushing up the uptrend higher from there. Doesn't mean the trend is reversing. Just that the price needs to cool off. It needs to absorb some new supply before that next leg up. And this is the range that institutions typically do that. We do see potential bearish divergence developing here. We do see second highest ever weekly volumes at all-time highs in extended periods. So all of these add up to high alert for us to be keeping an eye on and tracking, making sure that if we do start to see signs of profit taking on lower time frames, we need to be prepared to take necessary action on our ends, raising stops, cascading out of our positions, taking what we plan on swing trading out, and then reloading when they reload. Just an area that we need to start paying attention to, that we need to be looking out for. If they do back test these upward sloping weekly exponential moving averages right here and they hold, that would be our invitation to reload our positions as well. So we want to keep an eye on that. We want to look at lower time frames to see if we do see any signs of profit taking. We need to raise our stops, get out of our swing position or the amount of our position that we want to swing lower as Wall Street and as institutions swing down and reaccumulate their positions. We want to be prepared for that. So what we're watching is this white 9-day exponential moving average. You can see that it's been well respected the entire time during this uptrend. Institutions have defended this every time it pulls back. We do see price very extended here, and we are entering into this classic profit taking range. If we do see that 9-day exponential moving average lost here, and we do see it lost on additional or confirming volume, then that will be our to get out of our swing trade positions, stop out, and start looking at areas where we might look for Wall Street re-entering into their trades. It's that 9-day exponential moving average that we'll be keeping an eye on. Doesn't mean that the trend is over. Doesn't mean that it will not continue to keep going higher than that, because it could. It just means that we need to be aware. We need to understand what we're holding, where it's at in its cycle, and what institutions are likely to be doing, because that's really our edge in the market. No, we're not guessing tops. What we're doing is we're monitoring the institutional cycle. We're monitoring how institutions manage their money from when they buy their positions, when they break out into uptrends, when they take profit, to when they reaccumulate their position. We want to be aware of what they're doing so we can align ourselves, align our strategies with theirs. That's the edge that we're looking for in our swing trade positions. And to recognize all of those phases, to track everything to that degree, you need to be reading our full analysis, our top-down sector analysis, as well as all of our trade considerations. Take a look at this week's Clarity Spotlight on Hood. That's all we've got on Hood this week. We'll see you next.